SIP and asset allocation, balancing growth and stability in your portfolio. Welcome to today's video. If you're investing through systematic investment plans, SIPs, you've probably heard of asset allocation. But how do SIPs and asset allocations work together to balance growth and stability in your portfolio? That's exactly what we are diving into today. First, let's break down what we mean by asset allocation. Asset allocation refers to how you distribute your investments across different asset classes such as equities, bonds, real estate, or even commodities. The idea is to balance risk and reward according to your financial goals, time horizon, and risk tolerance. In simple terms, the right asset allocation helps you grow your wealth while minimizing the risk of big losses during market fluctuations. Now, let's look at how SIPs fit into this. SIPs can be a suitable tool for disciplined investing, where you invest a fixed amount regularly into mutual funds. But when combined with proper asset allocation, they become even more powerful. For example, if you're looking for growth, you might choose equity mutual funds. These funds invest in stocks which offer the potential for better returns over the long term. However, they come with higher risk, especially in the short term. On the other hand, if you want more stability, you might choose debt or hybrid funds, which invest in bonds or a mix of equity and debt. These funds are typically less volatile, offering steady returns with lower risk. By using SIPs to invest in a mix of these asset classes, you can achieve the balance between growth and stability, depending on your financial goals. Let's talk about how to actually balance growth and stability. If your primary goal is long-term growth, you might allocate a larger portion of your SIP investments to equity funds. For instance, 60% in equity mutual funds and 40% in debt or hybrid funds. This way, you capture the high growth potential of equities while having the stability of debt funds to smooth out the market volatility. However, if you're more risk averse and aiming for steady, moderate returns, you might want to reverse the allocation. 40% in equity funds and 60% in relatively stable, low-risk debt funds. This will still allow for some growth potential, but with more emphasis on stability. The beauty of SIPs is that they are flexible and can evolve with your financial goals. As you move through different life stages, your asset allocation should adjust accordingly. When you're younger and have a longer investment horizon, you can afford to take more risk by investing heavily in equity funds. But as you approach your goals, such as retirement, you might want to shift towards more stable investments like debt or hybrid funds. Remember, this is a process, and it is always a good idea to regularly review and adjust your SIP asset allocation to ensure it still aligns with your risk tolerance and financial milestones. A key concept in asset allocation is diversification. Diversifying your SIP investments across different asset classes, industries, and sectors helps reduce risk. For example, even with equity funds, you can diversify by investing in large cap, mid cap, or large and mid cap funds. This reduces the impact if one part of the market is struggling. In conclusion, SIPs can be a way to invest regularly and build wealth over the long term. When combined with proper asset allocation, you can balance the need for growth and stability in your portfolio. The key is to choose the right mix of equity, debt, and hybrid funds based on your goals and risk tolerance. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.